What if the loan you think is saving you is actually costing you thousands more? Today, I'm breaking down 5 of the biggest mistakes people make when using debt consolidation loans. And at the end, I'll share one mistake that can send you right back into debt, even after a consolidation loan. So, if you're thinking about using a debt consolidation loan or personal loan to clean up your finances, this video can save you money, stress, and regret. Before we get started, welcome back to my channel. If you're new here, hey, I'm Crystal, former corporate finance girly turned entrepreneur and personal finance educator. My mission is simple: to help underserved and underrepresented communities master financial literacy and build generational wealth. Because I believe anyone, no matter who you are or where you come from, can create financial security. So let's get into it. Let's first discuss what a debt consolidation loan is. A debt consolidation loan is a popular method used to manage debt, where multiple debts are rolled into one simple payment. For example, if you have 3 credit cards to pay off, you could use a consolidation loan to pay off the credit cards and only have one lender or financing company to pay each month. This can both simplify and lower your monthly payments overall if you do it right. While consolidation loans can be very convenient, the truth is, just because it sounds convenient doesn't mean it's always a good deal. When making the decision to use a debt consolidation loan to help manage your debt, there are several factors to consider, including some critical mistakes you should try to avoid. Now, let's get to those 5 mistakes to make sure your debt consolidation loan actually works for you and not against you. Before you sign anything, make sure you understand exactly what you're getting into. A lot of people confuse a debt consolidation loan with the debt consolidation program, and they are not the same. A program usually means you're working with a company that negotiates with your creditors to give you lower payments or lower your balances. They might charge fees or even tell you to stop paying certain bills while they negotiate on your behalf. But following that advice can actually hurt your credit because you still need to pay your bills. A debt consolidation loan, on the other hand, is a brand new loan, usually from a bank, credit union, or online lender that you use to pay off multiple high interest debts all at once. So before you sign any documents, ask yourself these questions: what's my total balance across all debts? What's my average interest rate right now? And does this new loan actually save me money or just make the payment look smaller? So just be sure to evaluate your full financial picture before you sign. Okay, mistake number 2. Now, this one's a biggie because many people see a lower payment and just stop reading after that. But the loan terms matter a lot. Ask these questions before accepting any debt consolidation loan. Is the interest rate fixed or variable? Because a variable rate may look good now, but depending on how interest rates change, it could go up, way up later on. Are there early payoff penalties? Some lenders charge you extra for paying off debt early. That defeats the whole purpose of trying to become debt free faster. What's the loan term? 3 years, 5 years, 7 years, 10 years? Longer terms could mean a lower monthly payment, but usually mean you'll pay more interest over time. And what's the total amount you'll pay when it's all said and done, including total interest, origination fees, and even late fees? Here's a quick example of why loan terms matter. If you take a $15,000 personal loan at 7% for 5 years, you'll pay about $2,800 in total interest. But if you stretch that to 7 years, your payments decrease slightly, but the total interest jumps up to almost $4,000. So read that fine print always. And if it feels off, just walk away. Now, let's talk a little bit more about how lower monthly payments might feel like relief, but can also be a trap. Let's say you consolidate $20,000 of debt into a 10-year loan at 6%. Sure, your monthly payments may drop to something that feels more manageable, but by the time you're done, you've paid thousands more in interest. Debt consolidation should be about saving money, not only shrinking payments. When you're comparing personal loans or debt consolidation options, always look at the total interest paid over the life of the loan. And if you can, pay extra toward the principal. Even an extra $50 or $100 a month can knock several months off of your payoff date. Just remember this: the goal is to simplify debt, not drag it out. So here's something most people never even consider: not all debt should be consolidated. You shouldn't roll every loan you have into one big payment just for convenience. For example, don't consolidate a car loan that's almost paid off. Don't include student loans that have lower interest rates or federal protections. And don't touch any debt that already has better terms than the consolidation loan offers. Let's take a minute for a quick example. Say you owe $2,000 for your car at 3% interest and $18,000 on credit cards at 22% interest. If you roll it all into one loan at 8%, you just raise your car loan from 3% to 8%. And that's a bad move. The ultimate goal is to lower interest, not raise it. So separate those debts. Only consolidate high interest, variable rate, or short term debts that benefit from the switch. For everything else, keep it as is and consider using a different debt payoff strategy to tackle those. If you need some ideas on how to do that, I go over 8 different strategies to pay off debt fast in this video. On to mistake number 5: not fixing the root cause. This one might sting just a bit, but it's the truth. Debt consolidation can make your finances look cleaner, but it won't fix the bad money habits. If you're not changing the behavior that created the debt in the first place, you'll likely end up back at the same spot. It happens. Some people consolidate, get some breathing room, and then start using those credit cards again. And within a year, they're right back to where they started. Here's what to do instead: create a realistic monthly budget, track every expense, every coffee, every subscription, everything. Build an emergency fund. Even $500 makes a difference. Automate your loan payments, and whenever possible, make small extra payments toward your principal. And remember, don't treat a debt consolidation loan as a reset button. It's a tool, and tools only work when you use them wisely. All right, let's recap what you need to consider when applying for a debt consolidation loan. 1, evaluate your options and understand what you're signing. 2, always, always, always research the lender and the fine print. 3, don't overlook the long term costs. 4, separate your debts and don't consolidate the wrong ones. And 5, fix those habits that caused you to be in debt in the first place. It may not be easy, but it can be done. Check out this video where I go into money management habits that could be causing you issues and leading you down the wrong path. If you consider these 5 things, you'll be way ahead of most borrowers and actually save money instead of losing it. Now, let's talk about next steps. If you're considering a debt consolidation loan, here's what to do next. Compare at least 3 personal loans side by side. I've linked a tool below that you can use to do that. Let me know in the comments if it works for you. You want to look for a loan that truly lowers your interest, shortens your payoff timeline, and fits with your budget. If you got any value out of this video, tap that like button. And if you're new here, consider subscribing for more practical personal finance tips. And if you want more gems on budgeting, saving, building wealth, and much, much more, check out more videos from my channel, starting with this one. As always, thank you for watching, and please remember to like, subscribe, and share this video with someone who's ready to get wild about wealth. Take care.